Hello and welcome to Currency Point, presented by me, Evan Lucas, for FP Markets. As always, please have a very good read through of the disclaimer on screen. Everything in this video is general in nature. None of it should be relied upon as any form of advice. FP Markets does not know your personal scenario, nor your personal financial goals, and therefore none of it should be relied upon as any form of advice at all. It's just general in nature only. I want to spend this entire video talking about what was very interesting from last Tuesday's RBA press conference, not necessarily the statement, the press conference, because I actually think that it's now tied itself in serious knots, and trading in the Aussie tells you that. Philip Lowe, it wasn't, in my view anyway, his most polished performance, but it did clearly tell us two things that the board is thinking with regards to how it's going to try and normalise rates over the next 5 to 10 years. And the metrics are incredibly hard to reach, considering that pre-COVID we couldn't do it. First and foremost, he highlighted very clearly that inflation, and that's core inflation, so strip out food and fuel, needs to be between 2 and 3%. It's target band. We know that, that's not new. But it's the fact that we haven't been there since the third quarter of 2015, and the fact that he wants to see it inside that band for consecutive, even as much as 3 quarters before they'll even consider it. That is an incredible amount of lifting to be done, considering at the moment we sit at an inflation rate of 1.1%. We are a country mile away from getting that level. The next part of the drive to help that inflation figure that he highlights is getting wage growth at 3% or better. We haven't done that for a decade, and we weren't looking like getting to that kind of point anytime soon. Now, I understand that clearly net migration is down because our borders are shut and international arrivals can't happen. But that will happen in the next 2 to 3 years, and therefore any form of uptick we get in wages, because we are getting a better employment market, no doubt about it, will probably dissipate. And that transit word, that transient discussion we all talk about, is going to come through. It's not going to be structural, because clearly from the economic side, we haven't really changed from pre and post COVID scenarios. And that is where I think the biggest indictment of this whole scenario is that clearly we can't drive ourselves forward. And the final part I want to really highlight with his discussion was that he talks about, they talk to business, and business's biggest, calling card back is that they're trying to control costs. If you're trying to control costs through having basically flat or lower wages, then how the hell are you going to get inflation? And therefore, how are you going to normalise the interest rate? Having the possibility of seeing the Australian cash rate at 1%, I think in the next 5 to 10 years now looks very, very unlikely. We might get some inverted commas normalisation of the rate going from 0.1 maybe back to 0.25 and back on the quarter notches, but nothing more than that. And I don't know if they've now put themselves into a scenario like Europe and like Japan, where a low interest rate environment is going to be the foreseeable future, that the ability to get the cash rate back up towards levels that we have seen in the past are gone. Now, that might not be a bad thing. Let's also probably think about that in another way. It's that it is about trying to create growth. It means that we don't have the inflation movements that we have in the past. But inflation is actually a good thing. Inflation means you spend today or you invest today because you don't have to wait for tomorrow, because you can't. If you've got an environment like that, it just means that growth remains stagnant and very, very sluggish. So there's a real problem there, and that's where the currency comes into it. The Aussie now has some, we've been talking about it for a couple of months, downward pressure, but even more so, the probability that interest rates differentials between the States, Europe, Japan and Canada with the Aussie are going to be different are quite high, and therefore the Aussie is going to get left behind. Again, not a bad thing, particularly if we look at it from an export point of view, but from a trader's metric, it gives us a very big standing understanding that fundamentally the Aussie now is under pressure because the RBA can't move.